that's really, really amazing. And that's great advice. I really like the savings aspect of it because I never thought of it like that. I always think like, how can I grow my money without realizing that, like what you mentioned before, like the more I save, long term, I'll have more to invest, which will only give me a higher return.
Hold up.
Well, hello everyone. I'm quite excited for today's guest, and we have also a special co-guest. So number one special guest and of course host, or the person who's going to be presenting, is Bobby Vu from Vu Financial. How's it going, Bobby? Welcome to the show. Now, Bobby, we were talking the other day, and it was actually, I was talking to people like Patience, who's our co-guest. Patience, say hello. And Patience actually is like a burgeoning real estate investor. She's 22. She's going into her third property. She actually, like, she's worked with banks in many different ways, and she just had some questions about, like, the bank keeps calling me now that I have a mortgage. Now what, right? Should I listen to them? Are they worth it? Or should I go the broker way or to someone else? What are the pros and cons? So Patience is going to be our special co-guest. She's going to have a ton of interesting questions that herself and also people in her crowd, her followers, she's a big Instagram influencer, questions that the people are going to have for you on post-mortgage. Once you get a mortgage and you want to rebuild wealth, you want to invest, where do you start? So she's going to jump in there with questions. Without further ado, Bobby, I'll introduce you. Bobby is from Victoria, BC, been in the game for a while. Officially, how long?
Just over 15 years.
So knows a thing or two, has a lens from many different angles. So Bobby, we're going to get right into it. Everyone that's watching right now has likely just gone a mortgage. They're anxious to get their next place. They want to rebuild wealth. The bank is calling them. Should they be ignoring the calls? If they're not ignoring the calls, what kind of a lens or ear should they have as they get pitched by the bank? Take it away, Bobby.
Thanks, Paul, and thanks for having me. Thanks, Patience, for joining us. In my experience, I've had sort of mini careers. So I spent 5 years at CIBC and doing jack of all trades and also helping with mortgages. Spent 6 years at Sun Life and the last 4 years being independent. So I've learned a lot and seen a lot. And basically what's going to happen after you get your mortgage is that the bank knows everything about you already. They know how much you're invested in terms of your accounts. They know your income. They know your other liabilities. So what they're doing with that information is they're trying to build the relationship by getting you to have more products and services. So the easiest next step probably is they're going to give you a checking account and they're going to say, hey, here's some free checks. So now you've got a mortgage. Now you've got a checking account, and then they'll probably say, hey, I noticed that you have an RRSP that you put down for your down payment. Why is it held at another institution? Can we take a look? And you're like, yeah, sure, why not? Let's take a peek at what you guys have to offer. So here's the challenge. When you got your mortgage, did you ask what the interest rate is? Like, that's obviously a yes. So you would never, ever, ever leave a meeting and not know what the interest rate is. So now we pose the question, do you know what you're paying in fees when you're investing? And that question is usually answered with question marks, or I don't know, I didn't know I had fees. So this is essentially the topic of our discussion today is, what options do you have to grow your wealth on the investing side? And when I mean investing, I mean in the markets, in the stock market, bonds, etc. But typically when you're working with a bank, they will guide you towards what we call mutual funds. Mutual funds have been around for a long, long time. There's nothing inherently bad about them other than you're paying some of the highest fees for this product. So kind of coming back to the nice person at the bank who's asking you to come to check out their products and services. I'm just going to scroll down my notes here. Now, if you've been on Instagram or you've been on Facebook and seen some of these ads. So in my, I guess not research, but just kind of nosing around what's out there, in the last week since Paul talked, I've had over 20 different sponsored ads from financial institutions. And the really interesting thing is that some of them are from the same institution, let's call it, the bank, and they're offering going into the branch, they're offering doing it online, and they're also doing it self-directed. And so that actually, even though I knew what they were talking about, that kind of piqued my interest in terms of each of the different avenues that you could invest with them. So within the branch, they will talk about mutual funds, which are going to be probably 2 to 2.5% in terms of the management expense ratio, sometimes known as the MER. So this is basically the fee. This is the interest rate. This is the cost to the investor. And what's really, really unfortunate is that not the entire cost is shown when you're investing with them. In the statements, they're not shown as well. So this could actually have a huge impact in your long-term wealth. Now, if you ask them, can you explain to me the breakdown of the fees, this person might not actually know how it's broken down because they just look at the one number and say, that's the all-in price. Now going back to the different departments, is that if you said, okay, yeah, I totally get mutual funds, I have some, and I've been investing in them before, but tell me about your other department. Tell me about your Robo Advisor. And if you don't know what a Robo Advisor, if you think of like Wealthsimple, they're the most popular one right now in Canada, and partly because there's a lot of investment money. So they just attracted, I think it was $750 million to invest into their practice, into their business. But when you look at the actual assets that they're managing, it's a drop in the bucket compared to the assets managed in all of Canada. So hopefully I don't lose you with these numbers, but there is about $2 trillion with a T dollars of mutual funds in Canada. And so that's to kind of reference it, that's the same as 2,000 billion. So about 1.6 billion, or sorry, 1,600 billion is managed by the banks. Yeah, is managed by the banks. Wealthsimple manages 5 billion. So who's having these conversations, right? Who's having these conversations? And the number of clients that Wealthsimple has, basically it's broken down to the average investor has about $30,000 invested with Wealthsimple. So this is still very new. This is still very fresh. But the challenge is that Wealthsimple is trying to get into a market dominated by the banks. I won't get into the other behind the scenes, who they're owned by and things like that, but the conversation needs to be more transparent and more widely available. So why would someone want to invest with a robo advisor? Well, their fees are about 0.75%. So 0.75 is only about a third of 2 to 2.5%. So imagine not having to pay that. So going back to the interest rate analogy, is that if you were getting something similar, would you choose a thing that costs less? The answer is obviously yes. So now I do want to be clear that the robo-advisor doesn't have a specific advisor that would help you, and you might be able to have a call on a 1-800 number or a video meeting, but it's not going to be as personal. It's going to be more generic. So you are trading off for not having that personalized advice. And I'll get into how you can fill in that personal advice in a moment here. So with these big banks, pretty much all of them have a robo-advisor option. And I'll just quickly talk about what a robo-advisor does. They basically take an algorithm and build a portfolio for you based on exchange traded funds, or ETFs. So ETFs are based on the idea that if you follow an index, which is just a list of companies, and a really popular example would be the Toronto Stock Exchange, the TSX in Canada. So that's 240 of the largest companies, of the largest publicly traded companies in Canada. And that's just a list. So that would be all, the big banks, the oil companies, resources, Shopify, the new number one, and they just copy the list. So if you're paying someone to just copy a list, it's going to cost significantly less than paying someone to pick and choose and dive deeper into if a company is worth it to invest. So that's where a lot of the price discounting happens. And there's a lot of information, research provided. So I would encourage everyone to look at a website called SPIVA. So it's SPIVA, as in Standard & Poor's, the investing, I just don't know. It's sorry, it's not investing, it's indexing versus active, right? So if you look at that, you'll find out that the idea behind passive investing will outperform active investing about 2/3 of the time in a regular market. And in some situations, upwards of 95% of the time, the passive will outperform active after the fees. So this is an important option that should be available and should be talked about, amongst investors. So now, going back to working with the bank, they have this option, but they're not going to talk about it when you're in the branch. Now, the next step that it kind of in line with a passive approach, as well as self-directing. Self-directing, it sounds like it's complicated. It sounds like, oh no, I don't have the time. But the world has made it easier and easier and easier. This is going back to, using a mortgage broker, is that if you understand that I want the lowest interest rate with certain options, your broker is going to find that for you. And if two things are the same, you're going to take the cheaper option, right? So if you strongly believe that these philosophies apply to your situation and you are a long-term investor, you can set it and forget it. Looking at a self-directed option isn't actually that challenging. So there's these things called asset allocation funds, and they're essentially what the Robo Advisor does, except it takes out the cost of the Robo Advisor. So instead of paying 0.75, you're going to probably pay about 0.2 to 0.3%. Again, no advisor, but if you have, the big rocks, the big major items in place, some of this is extra and you don't really need it. So kind of going back to summarize is that if you go and invest, you have mutual funds at 2 to 2.5%. You have the Robo Advisor around 0.75%. And then you have these asset allocation ETF portfolios that are about 0.25%. So if you need the help of an advisor, this is where it's a lot harder to find. And this is how I've built my business, is that you can hire a fee only or a fee for service advisor and pay them a one-time fee to get their advice. And then you don't have to continue paying them, right? It's similar to like if you had to pay for conveyancing with a lawyer, right? I need these documents done. It costs whatever, $1,200, and then that's done. So imagine if you owned your house and you had to keep on paying a fee, and the value of your house grows and your fee grows. Well, that, I guess property taxes would be something similar, but it's you're getting something for that, for those taxes paid. So this is what I pose to people, is that ask yourself, are you getting value for the fees that you're paying, and is there a way to challenge that cost? Because we know that in the long run, fees, interest, and taxes are the three biggest wealth killers in the long run. And you have some control over your fees. And so that's why I'm a huge proponent of like exploring these other options. If you are someone that wants to have an advisor ready to go, that's totally fine. but there are people that can complement the way that you're investing. And, just asking the question can we come up with an arrangement? Can we negotiate something where I'm just paying you for the time that I'm spending with you, instead of having a retainer or this fee that's ongoing, and you may or may not ever talk to this person. In my experience and from the studies that I've seen, is that typically once in every 4 years, a life event happens. And that's when you should be talking to an advisor. If you're buying a house, if you're getting married, if you're having kids, if you're changing careers, if you're getting a divorce, if you're retiring. So those things will happen, once every 4 years or so. So maybe that's the time where you pay an advisor, and the rest of the time you keep those fees. So I think that's kind of all that I wanted to sort of share.
Yeah.
Before I finish, I love I love looking at other marketing, right? So there is this particular bank that has questioned some of these robo advisors and said, hey, you know what? The line is, my advisor, maybe my advisor was right, and fees don't tell the whole story. So I flip that around and say, hey, you know what? Does the whole story tell you about all the fees? And if they can't answer that question, I would highly suggest taking a look elsewhere for your options. So that's kind of my, I guess, soapbox almost. Right. And yeah, Paul, if you have any questions, Patience, if you have any questions about that, I'd love to be able to answer those questions.
Patience, take it away. You are the featured co-guest. What's running through your mind? Thanks again for that, Bobby. That was great. Very informative.
Hi, Bobby. Thank you so much. I agree with a lot of your points. I like the idea of, having a financial advisor. Like, you need to be able to talk to somebody about these decisions, especially when you don't know. Like, you always have to admit that you don't know for you to be able to move forward. And like, I've noticed that with Paul, like, he always takes the step to educate before you just make a purchase or anything like that. So I'm definitely for the advisor aspect of it. Just a few questions. So what would you say in terms of saving for retirement is the best method?
When you say the best method in terms of like the different accounts and like if you want to invest in real estate, things like that?
Yes. So like the different accounts and the risk associated with it, and like long term, because like other people go for life insurance and it becomes an annuity. Other people, they tell us about the RRSPs, all those things. But from what you've seen, for somebody to retire and be comfortable and be okay, what should they start doing now?
Yeah, that's a fabulous question. So there's some key principles around wealth building and investing, and one of the things is diversification. And what that means is basically just spreading your different investment types. And I do believe real estate is a good piece. And the idea is that you don't go too heavy into any one particular area. And because as we know now, is that Toronto, Vancouver, even Victoria, some of the real estate pricing has skyrocketed. I've been in Victoria for nearly 40 years, and it's amazing what it costs for the average family, right? And so we think in tangents is that this is going to continue forever, and it's not, right? But that's why we have diversification. So coming back to your question though, is that for someone who's starting out, the savings rate, which is a percentage of the income that you're making, is probably the most important factor. It's not as important with the interest or the rate of return. So if someone comes up to you and says, hey, you know what, I have this shiny new thing and it will give you 20% rate of return. First of all, I would question 20% rate of return, but is that going to be as impactful as taking 20% or 30% or 50% of your income and putting it into an investment vehicle? Because the larger that compounds that percentage, then the more that's going to have an impact. Warren Buffett, if you look at his career, he made about 98 or 99% of his money after the age of like 52 or 53. It's because the compounding 20% or 30% on, a billion or 2 billion is a lot more than 20 or 30% on 10,000.
Yeah.
And so that's what I would say is that figure out of your budget what you can put towards the future, and that, enjoy yourself, but wouldn't it be nice to have those options earlier on? The other thing that I see all the time is the whole question about RSP or TFSA, and that's a Canadian thing, is that it really depends on what your taxable income is today and what your taxable income might be in the future. So it's one of my pet peeves when people are like, you should do this. And it's like, I have nothing similar to your situation and I don't make as much money as you, or I make more money than you. So thank you for sharing, but it really depends on a person's unique situation to really get the right investment vehicle. And it could be both, it could be one or the other. But I think that from what I've seen and what I've read, and is that people are a little bit leaning towards TFSA and more focused on that. And
what do we define those for the audience really quick? RSP versus TFSA, and I guess one of them is more income tax related versus the other one's tax-free savings. Really quick, what's the difference?
Yeah, the analogy that I like to use is, do you get taxed on the seed or do you get taxed on the harvest? So an RRSP has been around for like 60 years, and it's an incentive for people to invest for the future. So how an RRSP basically works is that you contribute to the registered retirement savings plan, and you reduce your taxable income. So let's say if you're making $60,000 a year and you put in $10,000, then you would be taxed on $50,000 instead. And that money grows tax deferred until retirement. One of the benefits is that you're not paying taxes while it's growing. The other one is that hopefully your tax rate in retirement is lower than your tax rate when you earned it. So if you're paying 30% while you're working, but you're only paying 20% while you're retired, that's a huge benefit. So that's getting taxed on the harvest. Getting taxed on the seed is more of the tax-free savings account, the TFSA. So you've already paid taxes on that money that you contribute into the TFSA. And so it grows, and you'll never ever pay taxes on those assets. So that TFSA, you've paid taxes on the seed.
That's really, really amazing. And that's great advice. I really like the savings aspect of it because I never thought of it like that. I always think like, how can I grow my money without realizing that, like what you mentioned before, like the more I save, long term, I'll have more to invest, which will only give me a higher return. I had another question about refinancing. So what I plan to do is refinance properties, take out the equity and invest it at a higher interest rate than my mortgage. When do you recommend is the best time to refinance? Especially with so for example, I purchased this property this year. Is there a specific time frame, or is it just when the property has has increased in value?
This is probably outside the scope of our conversation right now. But I would say that the most important thing is to be able to run the numbers. And if you think of real estate investing as like a business, right? What are the costs? What are the inputs? And what are the projected rates of return? And looking at that, I think working with someone like Paul, if you have some other real estate investors, and I've seen the spreadsheets, and they're actually really reasonable in terms of put away at least 5% for contingencies. The growth rate might be 3%, and so having a conservative approach, if you're projecting 10, 15, 20% growth rates, then you're probably going to get yourself into trouble. And just having extra money just in case, because what if interest rates change? What if something happens to the home? Let's say that just for contingencies. I think that's a really important part of the planning process. So when is the right time? I'm probably not the right person to answer that question, but certainly having some of those planning factors is important to just even to make that decision or get to that place.
Yeah, totally. And just to echo, Bobby, just we can talk about it more offline, patients, but like for the viewers, look, you're saying you're going to refinance maybe at a higher rate,
Oh, yeah.
and that might scare a lot of people. But what's the opportunity cost? If you're refinancing at a higher rate than what you got last, 4 months ago, hey, sorry, rates have gone up a lot, by the way, but the projected return of this next property is X amount of cash flow. It's going at this appreciation. If you run the numbers, if you pay an extra $3,000, let's say in a year, like I said, the rate was a lot higher. You pay $3,000 more than you would last year's or last time's mortgage, which, by the way, it's a sunk cost. You can't compare it to the past. But let's say you're like, oh crap, I'm paying $3,000 more. Well, if you're making, I don't know, 10K of cash flow plus the property went up 10%, I would give $3,000 any day to get 20,000 back. I think you just gotta, like I guess he said, run the numbers, and it's all about trade-offs, right? And I think that ties back obviously to investing. You're putting things into different categories. There's a trade-off of, I'm putting in a small chunk of money into like a sexy, NFT and or crypto, which, hey, like I love that shit. It might work in some ways, but it's very volatile. And even if I do hit it big on a very small amount, I'm not talking massive, but if you hit it like 30%, 40%, and then you were just so focused on like picking the right, crypto over, and then you forgot to, invest the rest of your savings, let's say you're 90% of your savings into like a 5% a year return ETF, and you just forget about that over time, 5% on a huge amount of money is probably going to be more than 30% on a small amount of money. So it's all trade-offs. It's all, like as he said, balance. But just run numbers and remember, try not to fall prey to your blind spots. How do you find out if you have blind spots? You talk to advisors like Bobby and myself, right? So it's probably a good roundup on today's sesh. Any last thoughts? Thanks for the question, by the way, patients. Any last thoughts, Bobby, on just key points to wrap up our session on what the bank may not be telling you and what the trade-offs are on fees when you invest?
Yeah, I do have a mutual fund fee video on my YouTube channel, so check that out. It goes pretty deep into some other fees that we didn't talk about today. And then there's another video that talks about how advisors get paid. So by all means, I believe that for the most part, advisors are good and they're trying to do the right thing. But the challenge is that they're caught in a system, right? So if you went directly to your bank to get a mortgage, they're probably going to offer the mortgage from the bank. If you go to a broker, they're going to look at the various options, even if it comes down to one or two that make the right fit. So having the confidence to explore, ask the questions, and have your spidey sense on alert if this is more about the institution or is it about the client or the investor. And that's what I encourage everyone. Go out there and ask the questions, take a look. And if you think that you're thinking of going on a different path, then I'm happy to have those conversations. And you can reach out to Paul to connect with me, or my website's pretty easy. It's voofinancial.com. And yeah, I'd be happy to have those conversations. I really would be excited to show more people that there's a better way, and that means more money in your pocket in the long run.
Always a better way. All the things you drop, by the way, will be in the show notes, of course, including Patient's Instagram, because she's got some cool stuff she's talking about. So everything's going to be in the show notes. Patience, thank you for the awesome questions. Bobby, I definitely learned some things myself, even just thinking about, getting taxed at the seed or at the harvest, little things like that, just kind of like make things click a little bit more. So for the viewers, thank you for being curious. Remember to ask the hard questions, not just to yourself, but to your advisors. And that way everyone gets to grow. And as always, keep leveling up your living.